Hi, welcome. Thank you for signing up. I really just wanted to welcome you into the training program. And I wanted to promise you one thing, and that is you will get a lot of value from all the material that you find on my website and all the different videos and posts that I will create. I don't know where you've come in from, I don't know where you've signed up from, so I just wanted to take a few moments before we get into a bonus training video for you and just explain some of the resources that are available to you. I have here the homepage of our website. This is where we post details about all of our live case studies. And we're going to go through a very detailed discussion today about one of the case studies so that you can start to learn all about options. You can start to learn all about stock options. So I just wanted to welcome you right now. And we also have a Facebook page where we put up very regularly all the live case studies that we post up. And here you can also ask questions if you don't understand a particular case study, but there's so much material available for you, absolutely free for you to learn more about stock options and how we trade using stock options. So welcome again. Thank you very much for signing up. And this is a bonus training video for you that is not available to anyone else, only for new subscribers. So I want you to feel very special, and I thank you again for signing up, and I really hope that you find all of this information very valuable. I'd like you now to just sit back, relax, and absorb all the information that we're about to share with you over the next hour and a half. It's a fairly detailed discussion where I walk you through a complete case study, a live trade case study that we did in early November on Coca-Cola stock. So pause the video now if you need to go get yourself a cuppa or a drink, and come back and play the video and just sit back and relax. And if you have any questions after the video, feel free to send me a reply on email or go and post a message up on the Facebook page. Get in contact with me. I'll be more than happy to answer any and all of your questions. Happy trading, and I wish you the very best of success in your trading, and I really hope you enjoyed this bonus trading video that we have prepared only for our new subscribers. And as I said, welcome aboard, and I really truly hope that you find value in all of the information that I share with you. Thanks again. Now, what I wanted to do is I like to reward everyone that takes action. So what I wanted to do is provide you some bonus training material so that you can start your learning experience straight away. Now, what I'm going to do for you right now is we're going to look at how options are used in the stock market. So to help me explain that, I'm going to go in and talk about one of the trades that we did for a case study in Coca-Cola. Now, you'll find, if you want to refer back to this case study that I'm going to be talking about and walking you through the entire trade, you can go to the Options Trading Strategies website and just find the post that I've got my cursor on, or just do a search up here for Coca-Cola, and you should be able to find the exact post that I'm using to walk you through this bonus training video. And let me tell you, this video is only available to you as my new subscriber. I have not posted this training video anywhere else on any of our resources. So I want you to feel very welcome, and I thank you for signing up, and I really hope that you get the most value out of this education material. So let's start straight away. And I'm going to now click on the original trade because this is actually an updated post. As we progress through our case studies, we post updates so that you can learn the entire process from start to finish. And what I mean by that is you learn how we looked at that particular stock, why we looked at it, the analysis stage of the particular charts, and the entry, the construction of our options trade, and any adjustments as the trade matures and as we either lock in profits or manage our risk. And I'll talk a little bit more about that as we go into this trading. So I'm going to click on this link here, which takes me to the original trade. And I won't read this to you. You can go away at your own pleasure and read the details of the case study. I will let you know that each case study that we document has a lot of detail. And I'll just scroll through this so you can see the type of detail that we put in, the effort that goes into preparing our education material for you. So all of this material is available at your fingertips on our website, where you can go in and look at how and why we constructed a particular trade, how it progressed, how we entered, all the different rules that we follow, and everything about that particular case study. So let me just scroll back up to the top. Now let me talk about some of these charts. Now let's look at this particular chart that we have on screen right now. It's the stock chart of Coca-Cola. You can see down the bottom we have the different months of the year that represent different price points of this particular stock at that point in time. On the right hand side we have the actual stock price. Now I'm not going to go into a lot of detail in what a stock chart is and how you read stock charts. I'm sure you can find lots of material on the internet about that. I want to go through and provide you detailed training on how we look at these charts and what we look at, and then how we actually construct an options trade to try and potentially profit should we be right on our prognosis, and also how we look at managing our risk if we are wrong in our prognosis. In fact, the first thing I generally do in my trading when I look at a stock chart and I'm preparing a options trade is I try to understand where is a point on the chart that identifies this trade to be void, in which case I would need to close the trade for a potential loss. So we'll talk a bit about that as well, and that is all around the money management. That is all around the topic of risk management. We always need to manage our risk. So if you look at this chart, there's a couple of things I want to point out. I want you to first focus on this blue line, this diagonal blue line, what this is actually referred to. And let me see if I can click on this and get a bigger picture. There we go, that's better. What this blue line represents is what is known as a trend line. So this actually means that the stock, as you can see, at this point in time, which is February 2014, the stock was around $37. Now, if you follow this blue line up, around August of 2014, the stock moved up to 39, and so on over the course of the year. It was up at $40 towards the end of October or middle of October, and now at the time when I took this picture, when I documented this particular case study, the stock was at 42, and that was most likely in the very first week of November. So we draw a trend line to try and get an idea of the general trend of that particular stock. Now, as something else that I want to point out, and very few traders look at this, if you look at these red lines that I have marked, these lines actually represent what we call pullbacks. So the stock has risen back here in October of 2013, has risen from 37 up to around about 41, and then it's had a pullback back down to this 37 somewhere towards the end of 2013, or sorry, I should say maybe the beginning of 2014. And you have another pullback here where this red line is also drawn, and another pullback recently back in October from this point 45 down to around about 40, more than 10%. Now each time there has been a pullback, I have measured the amount in dollars of that pullback. For example, this pullback, which is just a bit over 41, maybe 41.50 down to 37, is a pullback of approximately $4.50. The next pullback that I've marked is a pullback of approximately $3.50, and the next pullback is another pullback of approximately $4.50 in Coca-Cola stock. What that means is a pullback of between $3.50 and $4.50 is a very normal occurrence for this particular stock. And we do that to try and get an understanding of these stocks' personality so that we don't get concerned with these types of moves in this stock, because from its history we can see that they are in fact very normal for this type of stock. So that's very important to know. So let's go back and continue with that. Now, looking at that chart, the first thing I like to do is I like to measure the rally, the large move up, and I like to measure the most recent pullback in relation to the large move up. So let me see. I think I have a picture of this somewhere. Okay, here we go. Let me open this one up. Let me make it a bit bigger so we can talk about it. So we've identified that the major trend is to the upside. We've identified that these areas that I had marked in the past are actually what is known as the support. So this trend line also acts as a support line. What that means is you can see Coca-Cola stock has generally bounced from that level. At each point Coca-Cola stock has touched the trend line, it has actually bounced up. So that's what we refer to as support. Now, if you take this move back here in February, which is the very first what we call low pivot, it's the sort of low point of this chart, and you move all the way up and you look at the most recent high, which is up here at 45, we want to measure how many points that particular move is. And what we want to do, so that's roughly 37 to 45, so that's roughly $8 in terms of how much Coca-Cola has moved up. And what we do then is we also measure this pullback, which is 45 down to 40, roughly $5. And then what we do then is we try and work out a percentage of this move down, this pullback, in a percentage of this larger move. So we work out what is the percentage of this $5 move in relation to this bigger move from February up to February at 37 up to this 45, which is a move of $8. And software can do this for you, but you need to know if you are doing it manually, how we calculate that percentage. And in this case, the program that I'm using has actually calculated for me that this pullback is roughly 61.8% of this larger move. So what that actually means is Coca-Cola stock has recently pulled back, declined, you could say, 61.8% of its move, which I will refer to as a rally. So it's declined 61.8% of this bigger move. So it's gone up $8, come down $5 to $40, which is a move down of 61.8% of this move going up. Now, why is that important? Well, that's important because in my experience, and this is one of the trading methods that I use, is I have recognized in the number in all my trading that when a stock pulls back to 61.8%, in most times it generally rallies. Now, it doesn't work all the time. Nothing works all the time. But more times than not, the stock generally rallies, moves higher from that level. Now, another very important point here is that 61.8% retracement or pullback, retracement is just another word for pullback, and it means that the stock has retraced its move up, retraced its previous move up by 61.8%. The previous move up is $8. It's retraced that down $5, which is roughly 61.8% of that move higher. It's also not only retraced by 61.8%, which is a very key number, but it's also pulled back to the support line. Now, if you look at the history, what has happened in the past, with Coca-Cola, when this stock has pulled back to this support line, you can see when it's pulled back to the support line here, it's rallied. When it's pulled back to the support line here, it's also rallied. And this is an important level because in this case, the pullback is in fact 61.8% of that larger previous rally. So that's very important. And again, it doesn't always work, but in my trading, I have found that it works more often than not. And if we can manage our risk and manage our trade, we can have a high probability of winning trades with this simple method. It's that simple, folks. All you need to do is to look for a chart pattern like this where you have a rally and you have a pullback, and if you measure that pullback, which is simply how much has the stock pulled back as a percentage from its previous move high. Very, very straightforward. And software does that for you. You can see my software, all I've had to do is put my cursor here, drag it up to the top, bring it back down to where I am wanting to measure the pullback, and it draws for me different levels of pullbacks. And 61.8% is the level that I'm interested in. If I see a stock that has a pullback of 61.8%, then I want to look at that stock further. Okay, let's go back to the actual blog post and let's learn a little more. So once we have identified an opportunity, and for me that is a stock which has just had a pullback to its 61.8% level, from that point we can actually determine a potential target, for example, where that stock's potentially going to go. Let me just make this picture bigger. So remember we had a move originally from February up to 45, which occurred in October of this year, 2014. And then it had a pullback down to 40, and that pullback we measured was 61.8%. So what we do now is we measure this move, this total move from February low to October high, and we already had measured that. That is approximately $8. And what we do is from this pullback, we predict that the stock will move the exact same amount higher, for example, another $8 higher from this low, which is where the stock pulled back. So we're saying that our first target will be this number of points move higher from this pullback level. So the stock has moved in February from 37 to 45, a move of approximately $8. And now we're saying from this pullback, the stock will move up another $8. So from 40 to 48, that is our target one. And that, what we're saying, is a move of 100% of its previous rally from this pullback. So stock goes from February up to by $8 in October, comes down in October back down to 40, which is a reasonable pullback of 61.8%, and then our expectation is that the stock will continue to rise the exact same amount as was the previous rally from its current pullback level, so another $8. That's target one. That's 100% of that move. 100% because this move was $8, and we're saying this next move from this pullback is $8. So it's 100% projection of this previous rally from this current pullback level. And our second target, if we are to meet it, is a 127.2% move up from this level. Okay, now there's a little bit more involved in that, but that is the general idea. Once you see a pullback of 61.8%, you can potentially expect the stock to continue its major trend, which we've said is to the upside, and continue its major trend to its first initial target of $48. Now, what I will say also is as it's rising, you can see that it's going to have to go past its previous high where it was before. So as the stock rises and it approaches a previous high point, it will find what we call a little bit of resistance. It will struggle to get past that level. And the reason for that is because if you think about this scenario, let's say there were people who bought Coca-Cola stock at this level back in August at $39. And they held on to the stock all the way up to when Coca-Cola, which was in October, at $45. Now, what happened here was the stock actually declined. So a lot of people would have sold. A lot of people, for example, would have taken profits at this level, and therefore the stock declined, or the stock may have declined for other reasons. But there would have been people who would have held on to that stock even though it was declining and continued to decline all the way down to $40. And when the stock now continues to rise, as we are expecting it to, then when it comes back up to this level, those people who did not sell their stock at this level will finally say, now I better sell, because they had that fear, or they experienced that pain when they held on to the stock back here and it declined to 40. So when it reaches up here, there will be a bunch of sellers that have held on to the stock and they will want to get out of their positions, and that will cause the stock to slightly maybe pull down or struggle to exceed that level. And it may break through and reach our target. It may not. It may collapse back down. These are just potential targets. There's obviously no guarantee in getting to any of these targets. However, we construct our trade, we construct, analyze and put together a prognosis, and then we manage the trade. We put together a plan and we manage our risk as the trade progresses. So these are our two targets that we had established back when this particular case study was put on. And it was put on back here sometime in November with the expectation that this particular pullback is going to hold. The stock had already started to rise, had already moved up by around 5% or maybe more than 5% from 40 up to 42, maybe 42.50, and now we were of the we were thinking that, well, based on our method, we are expecting the stock to now continue to rise up to 48. So that's our expectation. And this was only done actually it was only done a couple of weeks ago, because the date right now that I'm recording this video is November the 25th, 2014. So we will be able to see how this trade actually progressed. Let's go back and continue to learn more. So let's just recap. We have looked at the original chart and established an opportunity because we have a pullback to a key level of 61.8%. And from that analysis, we have also established two potential targets. One target is $48. And the second target is $50, and that is basically projecting, firstly, the exact same number of points we had in the previous rally from this pullback, which is $8 from this pullback, so 40 up to 48. Okay, it's a fairly big target because, well, it's a good target. Now, let me say that in my experience, and I'll talk a little about this in a moment, I have been able to construct options strategies that provide a 100% return on investment with only a tiny 5 to 10% move in the stock. So this move from 40 all the way to 48 is actually a 20% move. So in my experience, we only need a move of roughly 5% to 10% to double our money. So that's great because we don't even have to wait for Coca-Cola stock to reach its target for us to make a nice profit. Now, one thing I'll mention here that I didn't mention in the previous, well, actually, let's continue because I'm sure I would have mentioned it in the post. So when we get to that, we'll talk about that. Let's continue. Okay, so our first target is 48 as we've now established, and our second target is 50 as we also have established. Now here I've clearly said I like to close my positions when I achieve a return on investment of 100%. And we'll talk a little bit more about that in a moment. Now, we need to understand one thing. There's nothing guaranteed in trading. While we do everything we can to put all different things in our favor, and even based on the historical behavior of the stock, we can see that the stock is most likely to continue on its path to a higher price in the future. But there's no guarantee. At any point, the stock could decline from its current levels and break any previous support level. There's nothing stopping Coca-Cola stock declining and going lower than that blue support line, even though the analysis shows that stocks generally hold their support lines. There's no guarantee. So what we need to do, therefore, is identify a point on the stock chart at where we feel this particular trade is void. Now, let me open this again. We can basically, we've entered this position on the foundation that this pullback is a strong support level and is a 61.8% level. However, if the stock goes below that level and therefore the pullback is actually lower, maybe 65% or 70%, then that trade is void because it does not meet our criteria. So if we're in this trade and we can see the stock's moving up higher and at any point it goes below, our support level, then our trade is void. We will need to close our trade and take any potential loss. And what we're actually doing there is actually limiting any further losses, because the idea that this is actually a key support level means if it's actually broken, meaning if the stock actually breaks that level, then in most cases it's going to continue going lower and could in fact go as low as the next level of support, which would be 39. The next support is where it's bounced before. Okay, so wherever something has bounced upwards is a key support level. So if it breaks this support level, it'll essentially get down to 39. If it continues and breaks this support level at 39, then you tell me, where's the next support level? Where do you think on this chart would be the next support level if this support level is broken? The answer is at the next level where the stock bounced up from, which is around this $37 mark. So that's what I mean when I say we want to limit any further losses, because if we break this support level, then the expectation is the stock could go lower and even further lower. So it's better to get out when the support level is broken rather than holding on to the position and letting the losses increase. And so we want to mark a level on the chart where we say our trade is void and we no longer want to participate in this particular trade. So the way I actually do that is, one, I have a level on the actual stock chart, which I call a technical stop loss level. And then I also have for example, when I construct an options trade, if the position that I construct goes down in value by 50%, then that's another indication to me that I no longer want to be in this particular position. I want to exit this position and take that potential loss and limit any further losses. And we'll talk about that in a moment. Let's go back to our post and continue learning further. And let me say, one very important thing is that you are disciplined in your trading. Trading is all about discipline, being disciplined. If you don't follow your trade plan, then you will not succeed in trading. You really need to keep your emotions in check and follow your trade plan. Do not second guess your trade plan. In fact, the trades I've lost most on in my early days were the trades that I did not follow the plan. I let my emotions get out of control. I did not follow the trade plan. I was not disciplined enough, and I lost more on the trade than I should have. That's very, very important. Okay, so you can see here I've mentioned that we need to determine where our stop loss is, and we're going to base that on an acceptable risk of 50% of our entry cost of the actual options position. Now let me talk a little bit about options because we haven't really covered what an option is. There's lots of material on the website. You can go on the website and there's lots of information where I define what a call option is, I define what a put option is. In fact, I think there's a couple of videos also that talk about what an option is, but let's also cover that in this bonus training because I want to make sure that in this early bonus material that you're now watching, you have all the background foundation information to at least understand this particular case study that we're walking through, but then to at least continue to understand all the future information that you're going to have access to. So that's very, very important. Now, let me go to NASDAQ.com, and I want to go there because you're also able to browse to NASDAQ.com and look up any particular symbol and look at what the stock options are for that particular symbol. So you can do this exercise with me right now. The pricing obviously may be different. The options you see may be different because they always change. So the information that I see today will be different to the information I see tomorrow. And depending on when you're watching this training video, when you have actually signed up to our education material, you will see different prices, different options in the options chain. Let me put in, let's say, Apple stock, and you need to know the symbol. You can do the search on the stock as well, I think. And let's just click on Apple and bring up Apple stock. Now, it'll show you the current price of Apple. It'll give you all the information about Apple, some charts and things like that. We're not going to worry too much about that. On the left-hand side, there's a menu, and on that menu, you can see a link to options chain or option chain. So you click on that link, and that will bring up the options for Apple stock. So let's do that. Internet's a little slow, just loading up. Now you'll see lots of different numbers, so I don't want you to get confused about all these numbers that you're now seeing on my screen. Let me talk through this to make it a little more clear. Let's break this down. These are the different types of options that are available to us for Apple stock, because Apple is the stock that we selected to view options for. Now, for me to explain this a little easier, let's first look at the current chart of Apple stock. Let's go in here. Let me switch over to the charting platform, and hopefully you can see that. Now, this is a stock chart of Apple, and right now the stock is somewhere around 120. In fact, if I put my mouse over here, it's exactly at 118.63. So let's talk about this for a moment. Let me just bring up something that I can write with. Let's just bring this down. So Apple today is at, let's just say it's 120. Okay? In fact, let's use the rule numbers. That's fine. Now, if you wanted to purchase 100 shares, let me make this font a bit bigger to make sure you can see that. Okay, let's see. Should be able to see that font. Maybe even bigger than that. Let's see. Just want to make sure you can see this up on your screen. Alright, so Apple is at 118.63. So if we were to buy 100 shares of Apple at 118.63, then the total cost would equal 118.63 0.00. $11,863 for us to buy 100 shares of Apple at 118.63. Now, one options contract actually controls 100 shares. So what that actually means is you could buy one call option and you would still have the ability to control 100 shares. When we buy 100 shares of stock, all that it means is we have the capability to control 100 shares. So we could do the same thing with a call option. Instead of buying the stock, we could actually buy a call option. So let's go and see what it would cost us to buy one call option that is close to the price, that is close to the current price of Apple stock. So let me go back to my previous screen. Okay, so let's look at the options. Now, let me talk a little bit about what you see up here because I need to select the right month. Options expire generally on the third Friday of each month. What that means is that that option will no longer be valid once it has expired. So you can see today is actually November the 25th and it's Tuesday. So these options that we're looking at, which is the November options, are going to expire this Friday. Now, without going into too much detail, we like to trade options at least that have a 90-day, that have at least 90 days before they expire. So if we're in November right now, then we should be looking at February options. So let's click on February to bring up the options that expire in February. And what we want to do is we want to either look at call options or put options. Now in February, we have these options available to us. Now, what I want you to look at is this column here called the strike price. That is the option that relates to the stock price. So remember the current price of Apple is 118.63. So I'm going to bring my mouse down to where the option that is just the next option after, like the closest one to the current price of the stock. So it's the 120 call option. Now, on this side, on this particular option chain, we have the puts, and on the left-hand side, we have the calls. We use call options generally when we are expecting stock to rise. So if we are going to replace the purchasing of a stock share, then we would look at call options because a call option will profit as the stock rises. And there's a little bit more information that you need to know, but for now we'll just keep it simple. Call option will generally rise in value if the underlying stock will rise in price. And it all depends on how quickly the underlying stock rises and which particular option we have chosen and which expiry period we have chosen. All of these things we go into a lot more detail as we teach you more about this topic. So This 120 call, and then what I might do is just filter on calls only so that you don't see all the put options on the right hand side of the options chain. And what I might also do while I'm on this particular screen is just talk a little about the different types of options, the different strike prices we have. You can see we can actually buy a call option with a strike price of 110. That means that will give you the option to buy Apple stock at 110, even though Apple right now is 118. However, the price that it was last traded at was $11.28. Now that's per share. Remember I said that a options contract controls 100 shares, so you will multiply that by 100. So that would mean this options contract would actually cost you $1,128 to be able to buy Apple stock at 110. So what that actually means is you're having to put up an investment of $1,128 to control 100 shares of Apple stock. Now, because that call option has a strike price of 120, which is lower than the current price of the stock. Remember, the current price of Apple is 118. We call this option in the money, and you can see it's actually shaded yellow. Okay, that's because the NASDAQ website shades the in-the-money options with this yellow background, so we know. And that's also why the 115 call option is also shaded in yellow, because it's also below the current price of Apple, which is 118.63. We can see the 120 call actually does not have that yellow background. That is because it is a call option. Its strike price is above the current price of Apple stock. It is a 120 call option, which is a couple of dollars above the current price of Apple. And it gives us the choice, it gives us the option to buy Apple stock at 120. And right now, Apple stock is 118. So why might we purchase this call option, even though it gives us the choice to buy Apple stock at 120? Even though we can buy Apple stock right now for 118? Well, because if you look at the cost of that call option, it's $5.28. That means we can control 100 shares of Apple for only $528. Contrast that with the cost of actually buying the stock. Remember, if we were to buy 100 shares of Apple stock, it would actually cost us $11,863. Now, going back to the options chain, the 120 call only cost us $528 should we purchase this particular call option. And I'll talk more about how the prices of these change and how we actually trade with stock options. But I just wanted to give you an idea of what a option is. So generally, we would purchase a call option with the expectation that the stock is about to rise, and the value of our call option will increase in value as the stock rises, subject to how fast the stock rises and subject to which particular option we have purchased, which strike price in relation to the current price of the stock, and the expiry of that option also has a factor on how the option value is calculated. So a lot of things to take into consideration. However, we make it very easy. So don't worry yourself too much about all these numbers. We will go into a lot more detail, not in this particular bonus training, but in further training modules to make it a bit easier for you to understand. So let's now get back to our education blog post. And whoops, that's my Facebook page. So let's get back to this chart. Now, we looked at some of those options, and at that point in time, we looked at the February 43 call. Now, we're talking about Coca-Cola now. Let me go into the options chain on the Nasdaq for Coca-Cola. Obviously, the call options will now be very different because that post was back in early November and now it is towards the end of November. But here are all the different types of options for Coca-Cola, and here's the strike prices. So we're looking at the November options. We could go to December or January or February. So just as I did before, we can drill down to just the call options. And we can see for November, the current month, which you wouldn't want to trade any of these options because they expire in a couple of days. All of these options are in the money because they are below the current price of the stock. So going back to the blog, at that point in time, we looked at the 43 call, and let me see. So remember the stock at that point in time was trading around that 43, was under 43. So that means the 43 call would have been out of the money. It's the next call option that is out of the money. Okay, so there was a 42 call and a 43 call. The Coca-Cola options were $1 apart from memory. And in fact, there might have even been 50 cents apart. There may have been a 42 call, a 42.50 call, which would have been very close to where the stock price of Coca-Cola was at that point in time here in November, early November. And there would have been a 43 call, which is out of the money because that call, that strike 43, is above the current price of Coca-Cola. Now, if there was a 42.50 call and if Coca-Cola was around 42.50, which I think it was, then we would call that particular option at the money because it's at the money. It's not below the current price of the stock and it's not above the current price of the stock. It's right near where the stock is right now. It's at the money. So going back to our particular trade, we looked at the 43 call and it was trading at $97. And then we wanted to reduce the cost of entry for our case study. We, at the same time, just as we purchased this 97 call, someone sold this 97 call to us, we also sold the 47 call to someone else and took in a bit of income, a bit of money. We took in $27 and that reduced the cost of our complete position for $70. So instead of paying $97 for a single call contract, we actually purchased this 43 call option and at the same time sold a 47 call option, took in a bit of money, $27, and therefore our total cost of this position was only $70 per contract. So with $70, we were able to control 100 shares of Coca-Cola at that point in time. And that particular trade, when we put it into our platform, is represented by this picture, which is known as a risk graph. And the first thing I like to do is look at where am I going to lose 50% of my entry cost. Now, the entry cost for this position is $70. So 50% of that would mean $35. So at which point is my options position going to be worth only $35, a 50% loss in the options, the value of that options position? And what we do here is we try to determine, so here's the stock price is up here on the left-hand side. The current price of the stock is here, which is $42.28. And all we do is we try and go down and see if Coca-Cola goes down, how much does Coca-Cola go down until we lose 50% of our initial entry cost. So on this graph, we could see that if Coca-Cola were to drop down to $41.20 from its current level of 42.28, then the value of our position would be minus 35. So that's roughly 50% because we purchased this particular position for a cost of $70. So if the Coca-Cola stock were to go down to 41.20, the value of our position will be $35 roughly. So we now know that we need to close our trade if Coca-Cola were to drop down from its current level of 42.28 back in November, early November. If it were to drop down to 41.28, then we need to close that position because that's the level that we have determined to be our stop loss level. Remember how I was talking about limiting our losses? That's the level that we have identified for us to say our trade is no longer void and we will close this trade for a potential loss. And what is that loss? It's exactly 50% of the entry of the position. So we enter the position for $70, and if the position value of that position goes down by 50%, which will be $35, then we will exit that position and take that loss and stop any further losses from incurring. So let's move on. Let's read on to expand our learning. You can see I've mentioned exactly what I've just described to you here in the post, that you can go back at any time and read in more detail if you wanted to further clarify exactly what I'm saying. And now let's work out the other side. So what I like to do is I like to exit my positions for a profit if my return on investment reaches 100%. So what that means is if we have entered our position and it's cost us $70 as what the cost is for our position, then when I make a $70 profit, I would like to exit my position. And what that means is when the value of that position reaches $140, which would mean we have a profit of $70, a profit of exactly 100%. And that's how I manage my trades. If I get a 50% loss on that particular position, I will exit the trade for a loss of $35 in this case because we purchased this position for $70. And if I get a profit of $70, then I will close the trade. Now, I will not always close the trade. I will either close the trade and take my profits, or I will make an adjustment if I can lock in the majority of those profits, thereby reducing my risk, and if I feel that the stock has more room to move in the desired direction. So, if you look at our graph and we move our point upwards, remember this is the current level of where Coca-Cola was at the time this particular case study was placed. If we look upwards on our chart, because this is the stock price here on the left hand side, and as we move up, that's the stock price rising. We can see the number that represents our profits. So we can see at this point, somewhere above 44, we have a profit of $70, which is 100% of the value of, which is 100% profit. Now we can see from this chart that occurs when Coca-Cola is around 44.55. So we can now see that our profit can be achieved if Coca-Cola stock were to rise from 42 up to 44. That's only roughly around 5%. That is incredible. We are able to achieve a 100% ROI, a return on investment, with a small, tiny percent, a tiny 5% move up in Coca-Cola. So that's the power of options. So we have a trade plan in place. We have a plan that says if Coca-Cola from its current level were to drop to 41.20, as seen here, then we are to close our trade and take a potential loss of $35 per contract. And if Coca-Cola would rise, which is our expectation based on our analysis, and then if it rises, it only has to rise to 44.55 from its current level of 42.28, then we would close our trade for a profit of 100%, or we may adjust the trade, do something to lock in some of those profits, and thereby reducing our risk. So I've mentioned that here in the post. The risk graph above clearly shows us that we would make a 100% return on investment should Coca-Cola trade at around 44.55. And that's a tiny 5% move in Coca-Cola. Okay, now here's what that trade plan looks like when I put it on the chart. Let's just click on this to make this picture a little bigger so we can see it's the same chart. Here's our trend line. And here's our stop loss. I've marked it here with a red line, and that is at 41.20 something. So if we go back and the level was, we said here that if the stock were to trade at 41.20, then that's the level where we say this trade is no longer void and we are to close that trade for a potential loss. So, whoops, that's not the screen I wanted. That is documented here. That's the red line here. So we can see that's where the current price of Coca-Cola is. It's up around here, this 42.28 area. If the stock were to go down and break this level, then where our trade plan says we need to close that trade and take that small loss. Now you can see that is also very close to the trend line. Okay, so if that area is broken, then it's a clear break of the trend line, and there's a higher probability that the stock will actually continue to go lower. Therefore, we want to close our trade at that level should the stock break that level, because it actually protects us from further losses. So we take a small loss and we move on to the next trade. Now we can see the green line here represents our, not our target, because if you recall, our target for this position is actually 48, but it represents where our particular position will make a 100% return on investment, meaning we've put up $70 per contract to get into this position, and when we make $70 profit, we identify that to be 44.55. If I go back to the post, we have said if Apple stock rises to 44.55, our potential profit will be $70, which is exactly 100% of our investment. And that's represented here by this green line. And this black vertical line is when the options expire. So we have chosen February call options, and they expire somewhere, I think it's 20th of February. So when we look at this particular chart, we need to ask ourselves a few questions. Is this stop level at a level where we believe there's enough room for the stock to move around based on its previous pattern, such that we won't get stopped out prematurely? So that's one thing we need to understand. Second thing we need to ask ourselves, is this target where our trade will potentially double, will make a 100% return on investment, is this target achievable given the previous pattern of the stock chart? And you can see Coca-Cola moves up pretty quickly generally. This is a large move. It's only taken 1 to 3 months for a large move from here. And so are we comfortable with Coca-Cola having to move from where it is today up to 44, which is only a move of 5%? Remember that I mentioned our target longer term, and if I go back to that original picture, if I scroll up, our target is around the $48 mark. When from a projection from $40, that's a 20% projection. Now remember I said when we were talking about that chart that in my experience I'm able to construct options trades that actually double in value, meaning provide a return of investment of 100% with tiny 5% to 10% moves in the stock. And here's an example of that. Our position will produce a 100% return on investment, and all Coca-Cola has to do is continue in its trend moving up but it only has to move up another 5%. So that's very, very powerful, and it has to do that before our options expire. So we need to look at this picture and say to ourselves, are we comfortable with Coca-Cola moving up to this green line within the time frame that we have? And we've got a bit of November, we've got all of December, all of January, and most of February for Coca-Cola to do that. So that's what we need to be comfortable with. Okay, and that's how I construct these positions. So let's go back and see and continue learning. And I've mentioned here that these are the questions that we need to ask ourselves, and very important that these case studies are for your education only. We do not make any trade recommendations. Do not take this as independent investment advice. It's for your education only, guys. Learn the art of trading by understanding how options behave with different market conditions. Now, I'm going to take this one step further for you. I'm going to go, using my platform, go back to this day, and we're going to see how this trade progressed, because I think that's going to really excel your learning experience. For the guys who had to read this post back in November, they had to wait for a couple of weeks for this trade to mature and for me to post up the updates. Now, in your case, you're going to be able to learn right now how this trade worked out and the different behavior that occurred for this position, the options position. So let me bring up the chart, and let me, using the platform, go back to this date, and then we'll see how this trade worked out and what adjustments, if any, were made, and at what point we actually closed the trade. And I'm not even sure if we actually closed it or if it's still on, because it's only been a couple of weeks. So let's do that right now. Okay, so let me say a couple of things before we move forward. We're going to be looking at my real live broking account. And a broking account is just like a bank account. There is obviously some sensitive and private information contained within that. So part of the screen will be blurred. You'll see everything that you need to see, but I'm going to have to blur part of that screen because some of that information is sensitive. So I don't want you to think that I am purposely hiding something from you, but as you can understand, there are thousands and thousands of people on my Facebook page that follow these educational case studies, and so I need to be careful with what I disclose on my recordings. So obviously, because it's a live broking account, which is just the same as a live, a real bank account, I need to be careful and try and block out information that's sensitive. So you will see part of the screen that is blurred. You won't be able to see that, but everything that you need to see to learn about this case study will definitely be shown. So let me first go to the stock chart of Coca-Cola, and what I have done is I've gone back to when we actually put this trade on, which is 7th of November, at which point you can see Coca-Cola was trading just above 42. And now let me switch over to the options platform where we actually put the options on, and you can see here that on the 7th of November, as I've documented in our website, we've purchased the 43 call, and at the same time we have sold the 47 call, and the total cost of that position is the net between the $97 we've spent and this $18 that we have brought in by selling the 47 call. Let me go back, because what I've done here is we actually put on 12 contracts for this case study, and that's because the risk parameters that we're using for our case studies is $1,000 per trade. What I'll do is I'll just go back here and just put in one contract so you can see the cost per contract. And in fact, one thing I will mention here is when I actually put the trade on, the 47 calls that we sold, we only got $18 for them. And if you remember in the post, the number was a little bit different. So the numbers changed at the time I actually executed the trade. So instead of costing $70 per contract, as what's documented on the actual post, it actually cost us $79. And we actually purchased 12 contracts for this case study because we're trying to keep the amount of investment the same. We want to keep the amount of investment consistent for every case study so we can actually monitor the entire portfolio and look at the performance over time. So the total cost for us for this particular trade was $948, and that is also the maximum amount of money that we can lose. Now, we're actually, as you recall, managing this trade for a 50% loss. So we've already established that if the stock goes down to $41, the exact amount was here. So if the stock goes down to 41.20, then we would exit this trade and take in a 50% loss. Now for us, that's going to be roughly $500 because we have purchased 12 contracts. Now, well, the maximum risk, let me just talk about that. The maximum risk can occur if the stock moves down dramatically, meaning that we did not have the opportunity to close our position at that $41 mark. For example, you may look at the trade and you go to sleep and you wake up in the morning, something's happened to Coca-Cola. There's been some incident, and the stock has dropped. It's gapped down. It's dropped overnight, and it's now at $30. Well, you did not have any opportunity to close your position at the $41 stop loss level. However, the good news is your maximum loss is known. If you were to hold Coca-Cola shares, for example, if you bought them at $42, and then the stock dropped down to $30, well, you're going to lose $12 a share. That's $1,200 if you were to buy 100 shares. In our case, our maximum loss is limited to this particular position, the purchase of these particular positions. So it's $948. Let's not get too bogged up with that component of it. Now, what I'm going to do is I'm going to move forward in this trade a couple of days. So you need to watch this right-hand side. Each bar represents a single trading day. Let me make these bars a little bit bigger. So let me also, while I've got the opportunity, to explain what these bars mean. Firstly, the length of this bar is the trading range for that particular day. So the low of this bar is 42.14. I'm looking at it over here. It says it on my platform. And the high of this bar is 42.446. What that means is Coca-Cola on this particular day, 7th of November 2014, traded from a range of 42.14 up to 42.46. And this little bar you can see on the left here where my mouse pointer is where Coca-Cola opened on that day. The open here is actually 42.45. And the one on the right hand side is where this stock closed at the end of the trading day. So it closed at 42.32. So it opened higher. It actually opened near its high for the day, traded all the way down to 42.14 and then rose again higher and closed at 42.32. We don't want to go into too much technical analysis in this training video. We can talk more about that over time. I'm going to just move forward a couple of days and see how this stock has progressed. So you can see that it's moving up nicely. And let's just put a little mark on the day that we got in. So we're the 7th of November. It's this particular bar here. So this is where we entered the trade. and now we're up here, and it closed at 42.79. So it's moved up slowly. Now our target we should look at, well, not our target, but where is our position going to yield a 100% return on investment? And we had already established that to be at a level of 44.55. So let's also mark where that is on the chart so we know where we're headed. 44.55. Whoops. 44.55. And we should also just mark out when our options actually expire. And to do that, I'm going to just collapse this chart a little bit so that we can bring in February, because that's the timeline that we've chosen. That's when the options expire. And the February options expire on the 20th of February. So it's the 1 to 3rd Friday of the month. Now that's not with all options. We need to talk a bit more about that later on. So we've got all this time to be right, essentially. So we can actually move forward in our options position as well to see what the options position is valued at on this particular day. So let's look at the 13th of November in the options position, which is over here. So I'm going to just go to the 13th of November, which is where our stock position is right now. And we want to look and see how these numbers have changed. So you can see that we're up by 20% and we have a profit of approximately $180. So not going bad at all. And it's only been a couple of days. We entered the position on the 7th of November and we are at the 13th of November and we've already returned a 20% return on investment. Now obviously this profit is not locked in any way until we either make an adjustment or close our position. So the money's not banked. At any point, if Coca-Cola would reverse, start to decline from its current level, then we would lose this profit and maybe even more. So let's progress the trade further and see how this stock performed over the next couple of days. So let's move forward by a couple more days. And also, I need to also put on this chart is where is our stop loss level? Where is the point on the chart that we're going to say that if the stock goes below, we are going to close this trade for a potential loss. And from memory, it's around about this 41.20 mark. So we're still okay, we're still within the range. So let's continue moving up, and you can see a very large trading range there. So you want to be aware of what's going on. I mean, that bar is not a normal bar in relation to the previous trading days. It's fairly large, a lot of volatility. I mean, there's a low here of 42.75 and a high of 43.86. The numbers may not make any sense, but when you look at that on a picture, you can see that that bar is nothing near any of the other previous trading days. Nothing we can really do about that, but that's just how it is. Some traders like to move their stop losses up as the stock moves higher, and if you see a bar like that, you may say, you know, there's the next sort of pivot low. You may want to move your stop above to that level. Now, I generally don't really muck around too much with these, but you know, some traders might move their stop loss higher and try and protect any gains they may have. And a logical step, a stop loss level would be here at this pivot point. Now, that's not the way I trade, but let's see anyway. It's not anything that I did anyway in this particular case study. I generally put the trade on and I leave it. I've already put into the computer if it's below my stop loss, get out. If it reaches my target, get out. So it's already set in the computer. I don't need to worry about it. So let's look on this day what's happened to our position on the 18th of November. Let's go to our options position and move forward to the 18th of November and see how have these numbers changed. Still loading up. You can see we have a nice 62% return on investment and a nice profit of 588. Again, it's not locked in, so it sort of makes sense to maybe put in, raise your stop loss level so that you don't lose a lot of that profit, or at least you don't lose on the trade, so that at worst case you might just break even. Now, I don't actually trade like that. I let the trade do its thing. Everyone has their own personality. Everyone has their own risk tolerance. Some people want to lock in their profits earlier, or at least prevent, once they're in profit, they want to prevent losing on that trade. And that makes sense. If you have $600 in profit, it wouldn't not sound logical for you to come out of that position with a minus $300. You would not like to change, you would not like to go from a position of $600 profit down to a loss of $300 because you did not either adjust your stop loss or did not lock in some profits. Now, I actually don't trade like that. As I said, I don't really get very involved in the trading. I have my targets and my stop losses, and I just let the trade do what it's going to do. So let's continue moving forward, and let's just have some fun with this and see if we can maintain this stop loss level. Let's continue moving forward, and we have another big day, and this is on the 19th of November. So just the next day, another. You can see here there's some big, closes. So remember these bars, there's the open here and a close here, and it opened slightly higher and closed again at the top of each trading bar. Generally, that's a fairly bullish, signal that there's some strength there. And if we put, some volume on, you can see the volume is also spiking. So that's very interesting. Now, a couple of things I'd like to mention. One, we're very close to our target. Second, we're also approaching the previous highs. So you want to sort of monitor your trades. Now, let's go here and see on the 19th of November with a nice spike in Coca-Cola, how our trade performed. Now, again, this is a live case study that we did. We posted this live when we put it on, and we're now, going back in time just for your benefit to show you how this trade worked out. Now, no one else has had this privilege. It's only to my new subscribers that you're able to see this video. So a really great learning experience. Now you can see we're at 96% return on investment. How would you feel right now with your emotions if you were at a close to 100% return on investment? Would you close this position right now? Meaning, would you, sell what you've bought and buy back what you've sold and close that position and lock in your $912 profit, 96% return on investment, and walk away? Or would you leave the trade on and try and get that last few more 4%? You want to get to 100%. These are the things that will go through your mind, folks, when you're trading. You really need to keep your emotions in check. And there's nothing wrong with taking this profit and walking away. You're really, really close to your target. I mean, there's nothing to say that the stock may not continue in its current direction. I mean, it's had two very strong days. It might start to come down, okay? It might start to collapse, and it might not. It might continue to go to all new highs. But certainly I would expect a level of resistance at this previous high, as I have mentioned before. So let's continue. Let's see how this case study progressed. So let's move forward another couple of days and see what happens with this trade. Now you can see here, this is the bar that we should talk about. And I actually have a post on our website about this particular scenario. Let me just check something here. So let's look at this bar. Let's make this a bit bigger. This will be very interesting to you guys and a very important lesson. The low of this particular trading day was 43.56 and the high of this trading day was 44.43. And the high of this particular trading day was 44.42. So that's 44.43 and 44.42. So what that means is this entire trading day was within the previous trading day. The previous trading day, certainly you can see it's, the current trading day is well above the lows of the previous day, but are the highs within the high of the previous day? So the high of the previous day was 44.43 and the high of the current day is 44.42. Only slightly, but certainly within the trading range of the previous day, and this is called an inside trading day. Now I'll talk about that more in another training video, but this bar is known as an inside trading day. You can see here, in fact, because it's here, I can talk about it a bit more. This bar also, on the day that we actually entered, is an inside trading day because it's low and high. The entire movement of that trading day is within the previous trading day's range. Now, what I have found in my experience, that when you get a close above the high of the bar before the inside day, which is the one over here, when you get a close above that bar, let's draw a little line there so we know what we're talking about. Here's the inside day bar, and here's the bar before that. And I'm saying when you get a close above the high of that bar, let me just draw that in. Bit of technical analysis for you, additional bonus training. So I want to see a close above this blue line, and you can see that doesn't occur until here, this particular bar here. Now, when we get another close that is higher than the close of this bar, that is generally a bullish indication, and that happens on the next bar. So let me say that again. Here's the inside day bar. Go to the day before and draw a line at the high of that particular trading day, which is 42.62 in this instance. Then wait for a close above that, which is here. And you can't wait too long. It's got to be within about 5 days. And then once you see that, wait for a higher close, meaning a bar that closes above the close of this bar, which is here. And again, you can't wait too long. It's got to be within the next 2 to 3 bars. When you get that, in my experience, most of the time, the stock will move higher. And you can see in this case, it certainly has. Now, we also need to establish at what point, if we were going to put a trade on with that particular approach, where would we say we're wrong? Well, you can put a stop at the low of the day before the inside day. So here's the inside day and here's the low. So if it's traded below that, then you would essentially close your trade and take a potential loss. So let's continue. It's now the 20th of November and we're very close to our level where we're going to make a 100% return on investment, and we're also very close in doing that. And we now have an inside bar. So the next bar is very important. You want to see something. Hopefully you want to see a higher close. You sort of don't want to see, and you can see that it's happened very close. It's already, we can see a bit of struggle occurring close to those previous highs. As I already indicated, there would be some level of resistance. So let's see. Let's move up bar. So we can see that we've now reached our target level, and we actually have an open, and the close is slightly lower, although the close is above the high of this inside bar. And remember what I was talking about down here, and you may need to go and rewind the video to clarify the rule. But now I want to see a close above this close, which is known as a higher close. And it doesn't really matter. And we've already hit our level, so we need to either close our trade or make an adjustment, but at least we'll know some sort of indication of where this stock is going next. It could be either going higher or it could be going lower, we don't know. But the fact that we're now so close to our previous highs, we need to do something. This is a point in our trade that we need to take some action. And first, that action might be that we actually close the position, or that action might be that we make an adjustment to lock in some of these profits and continue to profit should Coca-Cola continue to rise. So let's go back now to our options position, and we need to move forward to the 21st of November. So let's move forward up to the 21st of November and see the value of our position. So we're looking down here at our profit level, and so you can see we've hit a 112% return on investment on our original investment of $948, and we have a profit of $1,068. Now we still have over 3 months remaining of time before our options expire. So we still have a lot of time left. However, we've hit our target. So what do? Well, I'm going to leave you thinking about that, and I'm going to point you to where the post is on what we actually did, so you can go back and read about what we did on our website. So we go back to our blog post, and all you have to do is do a search on Coca-Cola, and you'll see some case studies come up. And so here's the original case study that we just looked at right now, posted 10th of November. And here's the adjustment that we posted on the 22nd of November. Remember, it's the 21st, on this chart, where we've hit our targets and made our 100% return on investment, which we can see is right there. Okay, today's date, 21st of November. So we posted that up for our readers on the 22nd. So go and look at that post and look at that adjustment. And what I might do is just show you a preview of what we did, but you're going to have to go into the post to learn about how we did it. So here's the actual adjustment. We were able to, you can see here, lock in $848. So no matter what happens to Coca-Cola, we have banked $848 on this date, 21st of November, but we still have the potential to make another $1,000. Our maximum profit with this adjustment is $1,848. Now, these numbers are going to be confusing right now because you're not reading the post. So you need to go back to where I said, click on that post and read the adjustment. The post goes into a lot of detail about what occurred, why we made the adjustment, how we made the adjustment, and talks in detail about how we constructed that trade to lock in our profits and reduce all of our risk. So I hope you have really enjoyed this bonus training. I want to welcome you again. Thank you for signing up, and I really hope you enjoy the journey along with us as we teach you all about this topic. And if at any time you've got any questions, go to our Facebook page at Options Trading Strategies and post us a message in the comments of any post, or post me a message privately if you need to. You can also reply to the email you've received to sign up. We're here to help you. Hope you enjoyed the video, guys, and we'll talk again soon.